Hi there, I'm Champion Trader Kevin Davey, and today I'm going to tell you about a study I did of a whole bunch of exits. I'm going to tell you which ones were the worst. These might be the ones you want to avoid. So let's get started. I have another video out there floating around that talks about which exits are the best. And you've probably seen webinars where people talk about magic exits, and the presenter will show a couple examples of when it's good. Hey, this video, this webinar, this was part of a webinar at one point, is different. It's based on actual rigorous testing, not just a couple examples. And I'm going to tell you what kind of exits work with what entries and what does not work so well. And it's over the last 17 years, so it's a big, a long test. But remember, exits are one piece of the puzzle. And the real secret sauce in algo trading is to have a good way, a proven way, to build your own strategies. And by building a strategy, it's not about creating a backtest. That's part of it. But you create a backtest and then you use a process that leads to good real-time results. That's the key. All right, so if you go to my website, hit the QR code, you'll find some old testing I've done with exits and tried a bunch of different things and came to certain conclusions. This work was a little bit different. Previously, I had found that a stop and reverse exit worked the best. And then it was followed by a dollar target. The reason I got the results I did, I had stop and reverse for all the strategies. This study was a little bit different. And the conclusion that I reached previously, that stop and reverse were the best, might not hold. Although I'm going to have stop and reverse as a candidate, I'm doing all the other exits without stop and reverse, okay? So if you have a profit target and nothing else, well, that's the only way to exit a trade, okay? And for those of you who follow TradeStation, who use easy language, even if you don't, you should be able to read this. But a typical stop and reverse strategy will go long. And by going long, the way it's set up, at least in TradeStation, is that it automatically exits any short trade first. So where I say here, if the close is greater than the close 10 bars ago, buy, what that means is first, exit a short, if there is any, then go long. And vice versa for when the close is below the 10 bar, or the close 10 bars ago. Exit any long, then go short. That's implied in buy and sell short. Then if you take away the stop and reverse, the way to do that is you use the keyword market position and you say if the market position's 0, meaning if you're flat and the 10 bar momentum is up, then you buy. But you had to be flat for that buy signal to work. So that completely separates exits from entries. So it's something different than what the studies I have on my website are. So I expect that I'll get some different results. The key thing with this bottom code here, if you just had this by itself, you would enter one trade and you would never get out. So you need exits with this. Where this top one, that code could be all the code in your whole strategy, because that will exit trades. It will go long or short. It's always in the market. And so the big problem with this is you need to test all these things, okay? Entries, exits, markets. To get enough data, you need to test a ton. And the hard part about this is you have to put a chart up in TradeStation. You have to select the market and the bar size, put the strategy in, you do your optimization, you run your analysis, you collect the results, and then you start over again. And that's a lot of work. My solution is some software that a student of mine wrote who took my course and said, hey, I really like what this process is. I just want to be able to do it faster. He's a computer programmer by profession, so he took it upon himself to write a great add-on that works with TradeStation. And it only works with TradeStation, by the way, but it will cut your development time, your test time by a ton. I estimated, based on a test I ran, 93%. So it goes from taking hours to taking minutes or even seconds. It's really good. And I can put in all my markets, all my bar sizes, do all that up front, say run analysis, and then I can go overnight and it can run and it can do all this. It could do a simple case really quickly. It's great. So here's what I ran. I ran almost 250,000 unique equity curves, and it took me 3.5 days of nonstop testing to get enough data. But then I was able to analyze those roughly 250,000 equity curves, and they're all unique ones. And I looked at profit and loss divided by average drawdown and was able to find the worst exits. And here they are. These are the worst 5. And what you'll see here is a couple of them are technical exits, meaning I did things like the lowest, close at the lowest of a bar of the last 3 bars if you're long. Or I did an RSI, and that turned out to be pretty bad. I did a fast moving average. If you're long and the price closes below a real short moving average, like a 2 or 3 bar moving average, exit. Okay, that would be a technical exit. The technical exits as a group didn't perform really well. And then the other ones you see are all stop related. Dollar stop, ATR stop, which would be average true range, and a stop that's a dollar stop with a break-even stop with it. Those were all the worst. And what does that tell you? Well, it just tells you that putting stops in decrease your performance. Okay? And this is regardless of what kind of entries you have. So I'd mentioned earlier, I was going to say which exits work best with the best entries or different entries. It really doesn't matter too much. The dollar stops and ATR stops are always the worst. So that's what I found in 250,000 backtests. Now, psychologically, you might want the stops. It is kind of scary trading without any stops, but a lot of pro traders out there do. And you might say, well, how do they do it? Well, one thing they do is they won't enter their position all at once. They'll kind of scale in or scale out as they're going along, and that kind of limits their risk. They still need risk help and risk reduction. That's still a big part of what they do. They just might not use stop losses for it, but that's hard to do. I've had strategies before without stops, and I've traded them, and I still remember one. It still hurts, where it was coffee, and I was trading it, and I knew it didn't have stops, and in the space of like 2 or 3 days, maybe even less, I forget, I lost like $15,000 per contract. It was like, wow, wish I had a stop. So psychologically, stops are good, but just remember, they're going to hurt your performance usually. Now, I did all this testing. That's what I found. But for you, what really matters is what you test, how you test. And if you believe the results you get, that's what's going to matter the most. Not what I did. It's going to matter what you did. And remember, exits are just one key to this whole strategy development puzzle. And finally, if you base what you're doing, your algo trading, on actual data, actual test results, things that you've done, you're going to be a lot more confident and you're going to be a much better trader than just relying on what somebody else tells you. So I realized I told you in this video what didn't work for me, but give it a try yourself and see. Maybe you'll disagree with me. Let me know in the comments. And subscribe to this channel, and I'll be sharing more videos like this. I'm Champion Trader Kevin Davey. Thanks for watching.